Great, thank you, James. That was all really interesting. Have we got Jeff on the line?
Yeah, good morning, Richard. How are you?
Morning, Jeff. I'm really well. How are you?
Yeah, good, thank you.
Good. Let's just put this in the full screen. There we go. Right. So, yeah, thanks for joining today. And yes, obviously a really important stage in the market at the moment, property market. So really interested to get your thoughts on where we are and obviously learn a bit more about your your company. So should we get cracking into the slides and you just give us a quick sort of 5-10 minute overview of what you do?
Yeah, happy to, and good morning, everyone. So I run the Schroder European Real Estate Investment Trust, which is a vehicle that's listed here in London on the main sort of stock exchange, and also has a secondary listing in Johannesburg. We set this up at the end of 2015, basically to give investors an opportunity to obtain income out of a sort of diversified commercial real estate portfolio in continental Europe. And it does nothing in the UK, so it's purely focused on buying sort of traditional bricks and mortar assets, both in terms of office, retail, industrial. We've got a data center in there as well, and you'll see that a bit later when I talk through the portfolio. It's about 250 million in size, so still relatively small, but we've actually done exactly what we said we would do in terms of focused on winning cities or growth cities, and by means of winning cities, it's those cities that would grow faster from a GDP, a population, or an employment perspective. And then at the micro level, we're using our teams on the ground to identify submarkets that will benefit from transport infrastructure changes, or whether there's competing demands for uses, supply constraints. And I think fundamentally, really looking at assets that are leased off affordable and sustainable rents, and you'll get a flavour for that in a minute. So we've built out and deployed the capital in 14 investments. We've sold a couple of investments over the last couple of years. We sold out of some retail in France, and we repositioned that into some industrial in the Netherlands and France as well. If you go to the next slide, thanks, Richard. So these are the assets that we've invested in, and obviously wouldn't be a real estate presentation without showing you some photos. So just to give you a bit of a sense for some of the assets and the themes that we've invested for, and I won't go through every investment, but take the asset in St. Cloud, which is the bottom sort of three in from the left. It's an office building. There's going to be a train station come outside this building in 2030. It's an asset that provides exceptional views over the river towards Paris as well. It's in a very sort of highly accessible area, and it's leased off rents of around 210 euros a metre. Prime rents in that area around 450. Prime rents in central Paris are sort of 900 to 950. So we're starting to see some sort of back office sort of being located in this area. And again, when we get the train station outside the building, we're going to see some pretty strong rental growth on the back of that. Similar in Hamburg, so the asset next to this is in an area called City Sud. It's one stop from the city centre. Again, we're off rents here of around 13 euros per square metre per month. Prime rents in Hamburg around 33. So again, being a huge discount to where prime is. This is a building that's fully leased. We had 5 vacant office floors at the start of the pandemic. We leased every one of those floors during the pandemic. Again, we had occupiers that were wanting accessible buildings and affordable buildings, and this certainly ticked both those boxes. And then on the retail side, we've actually had some really strong performing retail. Top left is a DIY unit that we've got in Berlin. Sits on 4 hectares of land. So the way we look at this is not just about the income today, but what can we do with that land in the longer term? And there's some really exciting options that we have here in terms of building some medium density residential or some offices here with that 4 hectares. We're leased to the leading DIY specialist in Hornbach. They've performed exceptionally well during the pandemic with everyone being at home and investing domestically. We've seen their sales sort of improve massively. So really strong covenant, and the income side of that will continue to be a very key part of the trust, but we have that angle for alternate use down the track. And then some of the logistics that we have. So in some really strong industrial locations, both in the Netherlands and in France. So we're typically focused on slightly smaller logistics assets, but again, covered by sort of strong covenants. And we've typically invested these between yields of early fives and upper sixes in terms of net initial yield. So again, where we've actually seen debt being highly accretive to those sort of yields that we've acquired off. The most recent acquisition we did was actually in Cannes. We bought a car showroom, bought the best asset in an agglomeration of 22 car showrooms. It's the largest frontage, the biggest site. We're sitting next to Lamborghini and Ferrari. Again, the alternate use on this is really exciting. We've got medium density residential behind us. So although it may be a car showroom today or in the foreseeable future, we're looking at this in terms of alternate use. It is zoned for residential, so there's angles there that we can work to try and create value going forward. Moving to the next slide. Just a little bit in terms of allocations. We set our stall out to be diversified, and that's something that we'll continue to be. So we're diversified in terms of sector, so roughly a third in offices. We're moving the industrial exposure to roughly a third as well, and the retail will continue to be somewhere around 20%, and mainly focus in terms of grocery and or DIY related retail. We've got a little bit of cash where we can invest, and we're looking at new investment opportunities with that cash that we have. That gives us a capacity to invest about 50 million, including raising some debt. And that's how we'll be looking to sort of broaden out and further diversify the portfolio through investing that capital. And again, sort of focusing on those jurisdictions where we have the strongest teams on the ground. So really, that's France, Germany, and the Netherlands. And obviously having that sort of multi-sector expertise within Schroders is a very key part of how we're going to be driving returns going forward. So overall, really strong occupancy levels. We've got about 96% occupied. We've had really strong rent collection during the pandemic. We're at 100%, other than that we have some exposure in a shopping centre in Seville, which we've written that position to zero, and it's got non-recourse debt on that, so it doesn't have any impact on the NAV. We're looking at trying to sell that asset at the moment, but the rest of the portfolio has been able to achieve 100% rent collection, and we're really, really positive in terms of how we've invested in some of the cities that we have exposure to. Moving to the next slide. Thanks, Richard. Just to sort of give you an indication of how we create value as an investment manager and as a specialist. What we did here was we had an office building that was in Paris in an area called Boulogne-Billancourt. It was a building that was 20 years old. We bought this in 2016. We had about 5 years left on the lease. It was a single tenanted building. It was in a very strong mixed use area, so not just an office location, but had that alternate use or competing demands for uses. We were leased off rents of low 300 euros a metre. The tenant here was a company called Alton. They wanted to stay provided we were able to refurbish the building. So we did an extensive refurbishment. We invested about 30 million into the asset. So it was an asset that was originally worth 40 million. We invested 30, and at the same time, we agreed a forward funding sale with an institutional investor at around 100 million. So we were able to crystallize about 28 million of pre-tax profit. And a really good example of how, as asset management experts, how we can create value for our shareholders through de-risking and managing that refurbishment process. We completed the refurbishment in June of this year. We handed over to the tenant and to the new buyer, and we're just finalising snagging items at the moment. So that was a fantastic way of how we could create value, and also now that's what's given us that capital, that 50 million that I touched on, about redeploying that and further diversifying the portfolio and strengthening the income side. Just moving through to the next slide, which is really positive slide around dividends and how we've been able to maintain and move the dividend back to the pre-pandemic level. Early part of COVID, a lot of investors, obviously, we weren't sure how the portfolio would hold up with the risk around COVID. We didn't know how values were going to perform, how our occupiers were going to sort of pay their rents and what sort of state they were in. So initially, we cut the dividend by 50%. We also had to de-risk the asset management play in Paris that I just touched on. And then once we de-risked that, which really only took us sort of 3 months to finalise the sale and to secure a construction contract and secure the lease with the sitting tenant. We then started to move the dividend back up. We saw very strong rent collection statistics, valuations holding up. And then within a year, we've been able to move the dividend back to that 1.85 euro cents per quarter. And then on top of that, as we finished the refurbishment in Paris and did that sale, with the extraordinary profit that we made out of that, we took the opportunity actually to give some special dividends back to shareholders, and that's what's culminated in about 9.6 euro cents that we've given back to shareholders over the last 12 months. So really positive play, and I think a lot of investors have welcomed that return of capital, and that still left us with around 50 million that I touched on before to redeploy, and how we can further diversify and strengthen the income and move the dividend cover back to 100%, because obviously selling the largest asset, we lost our biggest income side, and the flip side is obviously making the profit, but the flip side is that we were uncovered, and until we redeploy that 50 million, the cover will move back to 100% once we've fully invested that capital. So that's sort of a bit of background as to the portfolio, where we're focused, the strategy. Using teams on the ground, I think that's a key part of Schroders, and having sort of local teams in those countries that we've invested, and having multi-sector expertise. If you look at today's share price, which is pretty, and obviously been hit pretty hard with sort of greater geopolitical and economic risks that we're all dealing with, based on that sort of 1.85 euro cents per share per quarter, and annualizing that, you're effectively getting around a sort of a 7.5, 7.6 dividend yield based on today's share price. And given the cities that we have exposure to, and the strength of the investment management team, we think it's a pretty compelling investment case. We're lowly levered, so the gearing on this vehicle at the moment is around 29%. We can never go above 35%. We'll continue to run this with a bit of headroom against that 35% as well. The balance sheet's in a really strong position. Obviously, with that cash that we have, we've got a little bit of debt that's expiring next year. We're already in discussions with banks about refinancing that. So that's a sort of bit of background on the balance sheet side of things as well. But certainly the portfolio and the cities that we have exposure to, and the type of assets that we have, we feel really, really comfortable about managing through the headwinds that we're all facing. So I might stop there, Richard. I'm happy to answer any questions.
Yeah, thanks. Well, let's start there then, where you've obviously in strong cities, strong assets as well. What have you seen valuation wise? Obviously, we're seeing a lot of property values fall away at the moment. What have you seen in your portfolio so far?
Yeah, so we're about to sort of announce our Q3 results on the 6th of December, so I can't really sort of give too much specific flavour. We did come out with an RNS a couple of weeks ago around values, and they actually have held up very well for Q3. Now, in saying that, I think the valuers are still sort of struggling to see, I guess, investment comparables, because the market in terms of investment volumes has sort of dried up. So I think we will start to see some valuation falls probably from Q4, Q1 next year. But then when you sort of look at the underlying portfolio, you actually got to think, well, what cities are you invested in? What sort of net initial yields is one invested in? And this portfolio, we're at nearly a 6% net initial yield. So debt is still accretive when you are sort of buying and reflecting off of those net initial yields, and particularly the cities that we have exposure to. So we think the portfolio will continue to hold up well. We've got a bit of asset management that we can do on these assets as well, both in terms of shorter term, medium and longer term. But yeah, I think there will be a bit of a deterioration in yields as valuers start to see some evidence. Obviously, the market is pricing that in, just given the discount that we're trading off at the moment, which is about 30%. But certainly that's pricing in some valuation falls. But yeah, I mean, for the direction, probably start to see some minor falls from Q4.
Yeah. Have you seen any in the wider market?
I think the primer end, the primer ends, there's no doubt that we've seen a bit more movement and stronger movement, particularly on the logistics side of things, where I know we felt, and we were not participating in sort of investment processes where we're seeing yields at 2.5% to 3% for logistics, which we felt was pretty crazy, and not pricing those risks, particularly on the continent. When you think about logistics and the amount of land that's still available across Europe, and obviously Spain's a big country, France is a big country, Germany's a big country, Poland's a big country. So there's no real sort of finite supply of land. So we were never really buyers of that sort of pricing. Yes, there probably will be a little bit more rental growth that goes with the logistics side, but as we've now seen sort of interest rates start to increase, you can understand why the primer end of logistics has moved pretty quickly. So that's probably the first area where I think there's been some concerns around values. The logistics that we've invested in is not prime. It's still very, very good, sensible kit, and leased off affordable rents, but we've been buying off yields of between sort of 5 and early 7s that I touched on before. But that's probably the one sector where I've certainly seen some value corrections to start with.
Yeah. Okay. And then I think another obvious question that you probably answered 100 times in the last few weeks. What is your debt structure looking like? I know you touched on it there. How much debt have you got? When's that due to expire? What sort of terms are you looking at?
Yeah, so as a house, we're very much a modest user of debt. I think most of us in here have been through different cycles and seen how over-levered vehicles can sort of blow up pretty quickly when things move. So we set our stall out to be really maximum 35% LTV. At the moment, we're at about 29%, and we're at 20% if you actually take out the cash that we have. So a very sort of prudent and modest level. We do have some debt that's expiring over 2023. It's about a third of our debt. So, and that's linked to 3 different investments. One is 2 assets that we have in 2 office buildings that we have in Germany, which is the Stuttgart and the Hamburg office investments. We're already in discussions with banks about refinancing that, so I feel comfortable about refinancing that level. The other loan that's expiring is a logistics asset in France called Rumilly. It's a very small loan. It's about 3.7 million in size. Again, just starting discussions with the lenders there. I don't have any concerns about refinancing that as well. And then the other loan that's expiring is against the logistics or industrial assets that we have in the Netherlands. And that's a loan that we have with HSBC. And again, they're very much keen to lend with a counterparty like us in terms of being Schroders and the investment trust. And I think that's something the banks are continually starting to look at now about, well, who are they actually lending to? And they want to be lending to a real estate specialist rather than to someone who doesn't necessarily know how to sort of drive and manage real estate and protect their interests as well. So that's one of the things that we have sort of in terms of the feedback that I've had from banks is there is a very much a focus on not only possibly lending a little bit less in terms of LTVs, but actually lending and scrutinizing the type of borrower and wanting to sort of align themselves with investment specialists like Schroders.
That's interesting. And also, what kind of what's the differential between the sort of current interest rate and the interest rate you're negotiating? Yeah,
so basically the margins are similar. So the feedback I've been getting is that margins will for the LTVs that we have will remain. Yes, the 5-year swap has increased. So if you look at today's 5-year Euro swap, you're probably around sort of 280, 290 basis points. 12 months ago, that was 0. So we obviously that will sort of flow through when we refinance. So obviously to counter that is we are starting to see inflationary impact on the rents as well, and that's one of the nuances that the European sort of leases have is that you typically annually index to inflation, and I think that's a key message to get across to those on the call. In that 80% of our portfolio has annual indexation. The other 20% is actually linked to a hurdle, and once you actually reach a hurdle of say 10%, that's when you get the full indexation, and that's a very sort of different sort of nuance relative to the UK, where it's typically 5 yearly to market. So obviously that inflationary increase will help in sort of covering that interest expense, that increase in interest expense in terms of that 280 basis points increase.
Yeah, well, we got a question on indexation actually. So how you just mentioned it there, 8% annual indexation. Is any of that capped or is that uncapped?
No, we've got no caps in our leases. It may be something that some of the tenants may start to think about, but to date, I think we've all been quite surprised how quickly the inflationary side has moved. So a lot of the leases didn't really consider that inflation was going to sort of get out of control. So the existing leases that we have don't have any caps in them.
Yeah, and when do you expect that to start filtering through?
Look, I mean, that's for some tenants. It'll also depend on the strength of the location and the strength of the asset and where rents are as well. So it'll be a case by case basis as to whether one does consider caps and at what sort of level. But I mean, we do expect inflation to come back in sort of the medium term. So I mean, it's not obviously from an asset management point, it's not our intention to put in any caps in place, but certainly it's starting to see tenants starting to think about, well, actually the inflationary impact is starting to come through, and obviously any re-gears, they may start to ask for caps. Yeah,
that makes sense. Okay, and you did mention in your sort of intro that about dividend cover. We've got a question here on that. Do you just want to sort of recap on that again?
Yeah, so we always, as part of doing that sort of big repositioning in Paris, we always knew that we were going to be uncovered, and we'd actually did get a sense from the market. Did they want us to take and access that development upside, even though we were going to be uncovered, and actually we would still pay the full dividend out of the profits that we were making out of that repositioning, and it was a clear yes. Please take the profits, and obviously we knew that until we redeployed that capital, we were going to remain uncovered. So at the moment, where the direction that we've given is we're around sort of 65-70% covered, and that will move to about 100% towards the end of next year as we redeploy that capital. I mean, I think and we will start to see better buying opportunities. So I think in terms of the patient approach that we've taken to date has been the right thing. And actually, I mean, I'm very fortunate to have that capital and the strength of that balance sheet.
Yeah, well, let's delve into that a bit then, because like you said, it's probably a good time to have quite a lot of cash available with prices falling off. What sectors are you looking at? What sort of markets or countries? What cities?
Yeah, I mean, we will continue to be diversified, and we're not deviating away from the strategy that we set. I think that's put us in really strong stead to date, and we've delivered sort of nearly double-digit total returns on average for the last 3 years. So we'll continue to invest that way, and obviously having teams on the ground with multi-sector expertise, that's what we will continue to tap into, and we have a proven track record in actively managing real estate as well. So I'm sort of agnostic in terms of the sector, but in saying that, I did allude that I would like to try and increase the industrial exposure to roughly a third. At the moment, we're around sort of 26%. And then I'm selectively looking at offices and retail, and if on the retail side, it would primarily be more on the grocery and DIY side. And again, those are two subsectors that have performed very well, and we think will continue to hold up exceptionally well once we return to growth. And on the office side, again, it's going to be looking at more sort of accessible and affordable locations and areas where, if we can improve the sustainability in office building, we're happy to do that, just like we did in Paris with the Boulogne-Billancourt example that I gave. That's how we can create value. So we're not shy about taking on that risk and using our expertise to de-risk that.
Yeah. Are you looking at, I know one of your most recent ones, that acquisitions was a car showroom.
Yeah.
Are you looking at alternative sectors like that?
We are. I mean, it's not my intention to run around and buy further sort of car showrooms, but if it's a good real estate deal and makes sense and is in a growth city, and an attractive sort of yield profile, and we can manage that risk, I would. But we just felt that was a sensible investment, and really stacked up both in terms of income, but also that alternate use angle that I touched on with Resi. We've looked at a couple of data centers as well in terms of alternatives. Looked at some of the sort of the healthcare side of things as well. But to date, just haven't seen the right investment to justify adding that exposure.
And the portfolios, France, Germany, and Netherlands. Are you going to look outside into other markets?
I think for now we're happy to focus on those three jurisdictions. I think if we were a larger vehicle, I would look at some other jurisdictions. Probably be more the Nordics, where we have a strong team on the ground there as well and can execute. But I think for now, it's probably more France, Germany, and the Netherlands, and possibly if there was the right investment, I possibly would add something in Belgium. But I think really it's going to be those three main sort of jurisdictions that will continue to focus. Yeah,
and that brings wait, you got the Seville shopping centre in Spain. What is the latest with that? I know you marked it down to sort of zero. What's the sort of long-term plan with that asset?
Yeah, so we're in the market to look at moving that on. So we're working with the bank at the moment. So we're been given an opportunity to facilitate a sale. That the debt on that is ring fenced to the asset, and that's one of the sort of key points, that the way we look at debt is that it's non-recourse to outside the asset. So I think that's an important point, and we've been very clear with the bank that it's not our intention to invest further in this, and hence working with them about moving this on. So it is the right thing to have written the equity on this to zero. So that's the guidance we've sort of given the market for the last sort of 18 months now.
Yeah, no, that's fine. Through here, obviously another big subject is ESG. Can you just sort of talk through the ESG credentials of the portfolio?
Yeah, so we will actually, with the announcement on the 6th, so we've had a review of our GRESB ratings. At the moment, we were 3 stars. That will improve. That's sort of testament to the work that we've been doing in terms of some of the sustainability and social initiatives across the portfolio. We're starting to model all the assets from a net zero point of view, so it's still sort of early stages around that, and obviously looking at initiatives, or how can we improve respective ratings, whether that sort of be BREEAM ratings or Fitwel ratings across the portfolio. We do think there's probably going to be stronger rental growth that goes with better quality certified buildings. So hence where we have an opportunity to reposition an asset like we did in Paris and turn that from a grade C to a grade A BREEAM rated building. We do think that's going to create sort of stronger rental growth. So there's a couple of examples in the portfolio where we can do that. The best example is, say, the data center that we have in the Netherlands in Apeldoorn. It's an asset that is leased to KPN, so it's the leading Dutch telecommunications company. They have a very clear focus to be more sustainable as well. And one of the initiatives that we're presenting to them is to turn this into more of a hub location and invest heavily in that asset. It's an asset that's unlevered, so we would look to probably use a bit of debt and lever that asset to pay for any refurbishment that we did. But we would only refurb that building if we were able to sign a new sort of long-term lease with KPN. So yeah, I mean, the whole, in terms of looking at EPC ratings and how do we improve ratings, it's something that I work extensively with the asset management teams on the ground. But the portfolio, it's not the primest portfolio as you saw in the photos earlier, but there's certainly still functional assets. I mean, the Hamburg asset's a good example, where you've still got occupiers out there that don't want to be in a prime building, and that's a building that we leased up the 5 floors that I touched on during the pandemic, because its success is due to the fact that it's accessible and it's affordable. So yes, it's a grade B building from an EPC point of view, but it's still highly demanded. So that's the type of assets that we'll also focus on in terms of being or starting with positions that are accessible and affordable, and then we can actually do something with that. If we had a tenant that, say, wanted us to turn it into a grade A BREEAM rated building, just like we did in Paris, we can do that, and we can increase the rent accordingly to help pay for that investment that we make.
Yeah, and it's not just tenant led though, is it? If you get an office back or something, would you consider doing a full blown refurbishment of that before trying to let it out, or what would you do there?
Well, I think I mean, just like we did in Paris, it's more about sort of working with our occupiers and saying, well, actually, what is it that you want? And again, this operational expertise that we have, and working and being very close to our occupiers to understand what it is that they would prefer. So in the case of Alton, they wanted to stay in the building, but they wanted us to refurb that and take it to a certified status. So that's exactly what we did. Same as in Apeldoorn that I touched on as well, trying to work with KPN. If KPN didn't want to stay in this building, I think the alternative on that is probably to residential. We wouldn't do that, but we would probably get planning and then sort of sell that asset on. It's not our intention to really be looking at sort of vacant buildings and repositioning without any sort of commitment. So really the focus is to try and de-risk that now as we've got relationships with occupiers, and de-risk that with the tenant.
Cool. So what kind asset management activities are you undertaking? And we've got another question here on how, over the longer term, how much of your returns do you think come from your asset management initiatives?
Yeah, we haven't really given any guidance around sort of returns, but what I can sort of touch on is some of the initiatives that we are working on. Obviously, initially, it's around leasing some of the vacant space that we've got. So we've got about, what I sort of highlighted before in one of the earlier slides, we had about 4% vacancy, and that's primarily in one of the office buildings that we have in Paris in St. Cloud. So it's about leasing that space. We're also doing a little bit of work in Frankfurt we've got a grocery anchored asset there leased to Lidl. So we're looking and having some discussions with Lidl about expanding their premises and regearing them on a longer term lease and doing a bit of tinkering of some of the other tenants. Obviously, Apeldoorn is probably one that's going to move the needle if we can secure a new lease with KPN. And that's the focus there, but it's still a little bit early to de-risk that. It's still about 4 years left on that lease. And then outside of that, it's some of the locations that will improve on the back of infrastructure changes. Now, Stuttgart is another good example. It's an office building that we have there. There's a massive redevelopment going on for the main train station. We will benefit from that. It's the completion of that's now been pushed out to 2024. But again, it's a sub-market from an office point of view that has the record lowest level of vacancy in the whole of Europe. So we've got vacancy rates there of about 1 to 1.5%. So there's just no availability for occupiers to take space. We feel really comfortable about that office exposure. And again, being leased off a relatively low rent of about sort of €15 per square metre per month, which is about half of where prime rents are in Stuttgart. And then longer term, this is the one that excites me the most, is the longer term play that we have in Berlin with that 4 hectares of land, and about how we can use that site to a higher and better use. And although it's a DIY single level building that takes up about a third of the site, the longer term aspirations are try and get planning approval to see how we can do a mixed use development there. We wouldn't do the development, let's be clear about that, because we're an income focused investor, but we would get the planning approval in place and probably sell that on. But that's the exciting sort of asset management play that I see. There's still potentially another sort of 10 to 15 years lease that the tenant has. They have a couple of options here. So that ability to create that value may be pushed out depending on when we can get vacant possession. So there's sort of 3 or 4 examples of some asset management that we're starting to work through. Yeah,
that's cool. So obviously you've got quite a lot of exposure to the offices sector. How do you see that sort of demand in that sector over the next couple of years?
Yeah, I mean the office sector is still, I guess, trying, and occupiers are still trying to sort of bring forward their post-COVID sort of ideal basis, and I guess a lot of employers are still working through with their employees around work from home and what is a sort of a hybrid approach. There's some companies that are saying, well, actually, we want you back in the office. We want you. That's where we see the better productivity. That's where we can actually sort of bring on our sort of corporate ethos. We do sort of believe that those sort of more sustainable buildings will probably see better rental growth. So it's those buildings that will provide and cater for agile working. Those buildings that are probably a little bit more tech and data driven. Those that have sort of something that creates a better environment for employees. So whether that be sort of breakout areas, terraced areas, gyms, canteens, those type of things. So that they're probably more the certified buildings. You'll probably see stronger rental growth. In saying that, we also do believe, and this is a theme that I touched on, is that we do believe that if you've got an office building that is accessible and affordable, there's going to be a lot of occupiers that are still going to want that, because they've only got their teams coming in 3 days a week. They don't want to be in a prime building, and they're happy to be in an asset. And Hamburg's a good example where we leased 5 floors during the pandemic purely on the basis of that. It is highly accessible. It's one stop from the city centre. It sits in an area that's a mixed use area where it's not just offices. There's quite a lot of residential and retail. And if your sort of employees can walk or ride their bike to work, it's going to remain a very relevant asset. So that's where we see offices and focusing our strategy around actually having more certified buildings that are going to probably benefit from stronger rental growth, or being in office buildings that are leased off affordable rents, but are highly accessible. And I think that's the key that still goes with office strategies.
Yeah, no, that makes sense. So do you have any worries about vacancy growing over the next year, obviously heading into a recession, or your tenants' covenant strength pretty strong? What do you think?
Yeah, I mean, we're pretty well diversified. I mean, the logistics side, that's probably a sector that has performed very well. And obviously the pandemic has changed the way that distribution is being done. So movement away from just in time to really storing goods. And obviously the whole sort of trade restrictions with China, we're seeing goods being stored for a lot longer domestically, and also businesses starting to think about diversifying away from China as well, and having sort of manufacturing and distribution more domestic as well. So that's why that sector has benefited. So we don't see, in particular the locations that we have, we don't see any sort of concerns around why we think any sort of vacancy would occur there. We're in submarkets that are pretty tightly constrained as well. So again, coming back to one of those themes that I touched on. So even if one of our tenants was to want to depart, or we feel that we could lease that space pretty quickly. The retail side, again, very strong, and if Hornbach was to deteriorate, I feel I'd be welcome to take actually vacant possession on that, because of that angle that we have on the alternate use and being able to use that 4 hectares. Equally, I've got no concern around the grocery side with Lidl. Obviously Seville I've talked about, and we're moving that on, and there's non-recourse there. I think the one that's probably if vacancy is going to be a bit bumpy is the Saint Cloud office building in Paris, where until the train station really gets built, which is now going to be 2030, it'll probably continue to be a bit bumpy. They're SME type businesses. So at the moment we've got about 17% vacancy in that. We're working hard about leasing that vacancy, but it'll continue to be a bit bumpy in the medium term. So that's probably the one asset where there may be a bit of sort of more management time that goes into de-risking that.
Cool. Probably got time for one more question. Is the income hedged to sterling?
No, it's not. We we took a position actually at the IPO, and we did sound out a number of investors what their preference was. Obviously, there was a cost that was going with hedging income, and that was going to be sort of too expensive in terms of diluting that yield. So we elected to not be hedged. Obviously, we're hedged in terms of the debt that we have because all our debt is in euro. Investors can actually take their dividend in euros as well, and that's been attractive for some of the Irish investors that we have on the register. But no, for now, the intention is not to hedge the income when we move across from euro to sterling.
Cool. Okay. All right. Well, thanks a lot for your time. That was all really interesting. Really look forward to you guys doing some deals with that cash and see where you're going to deploy it. And bring
No, excellent. Well, look, we will be presenting the annual results on the 6th of December. So for those on the call, if you want to listen in to a webinar that we're going to give, and you'll see obviously the investment report that will come out with on that day with the results as well.
Yeah, cool. Okay, look forward to that. Well, thanks a lot for your time, Jeff.
Brilliant.
And all the best with it.
Thanks, Richard. Cheers.
Cool. Right, so just leaves me to go through what we have coming up in the next few weeks. So we've got Murray International next week, followed by a full sort of roster until the new year. So we look forward to seeing you again next week, and thanks for joining us.